Hello traders, welcome back to the channel. In this video, we'll quickly review last week's market performance, analyze the Nifty outlook for next week, discuss key technical support and resistance levels, and examine the latest option chain and FII/DII data to understand what the market may be signaling. Let's get started. Let's begin with a quick recap of last week's market action. Nifty 50 extended its positive momentum, gaining nearly 187 points to close at 24,570.65. The index remained volatile throughout the week, touching an intraday high near 24,774 shortly after the rollout of SEBI's new closing auction session. The newly introduced CAS also kept the final minutes of trading highly volatile throughout the week, with sharp price movements seen around the closing period. The rally was supported by strong earnings from IT heavyweights like TCS and Infosys, along with gains in PSU banks, auto, and metal stocks. However, late-week profit booking in heavyweight financial stocks, including Bajaj Finance and ICICI Bank, combined with rising Brent crude oil prices, capped the upside. So, with the market still holding near its recent highs, the key question now is, can Nifty sustain this momentum, or are we heading toward another round of profit booking? Now, let's look at the key market cues for the week ahead. First, developments around US tariff policies on China and India could keep global trade tensions and market sentiment in focus. Second, crude oil and geopolitical cues remain important, with Brent crude trading above $81 to $83 a barrel, adding to domestic inflation concerns. Third, the final leg of Q1 FY27 earnings could continue to drive stock-specific action and sector moves. And finally, US non-farm payrolls and CPI data will be closely watched, as they could influence global rate cut expectations. Now, let's look at the technical outlook for Nifty. On the daily chart, Nifty continues to trade constructively above its 20-day and 50-day moving averages. The index is currently attempting a breakout from an ascending triangle pattern. Despite a gap-up opening, the new closing auction session mechanism also saw an attempt to push Nifty higher, but the index failed to sustain the upside and overall movement remained relatively muted. The key hurdle continues to be the 24,650 to 24,780 zone. A decisive daily close above 24,780 could trigger a fresh bullish breakout, opening the door toward 25,000 to 25,200. On the downside, immediate support is placed around 24,450 to 24,380. If this zone breaks, the next key demand area lies between 24,200 and 24,100, which also aligns with short-term moving average support. Overall, the technical structure remains positive as long as Nifty holds above 24,200. Now, let's decode the Nifty option chain to understand where the major players are positioned. Starting with the upside, 24,600 is emerging as a strong overhead cap. We saw massive fresh call writing at this strike, with nearly 99,000 contracts added. At the same time, significant put unwinding between 24,600 and 24,700 indicates that sellers are becoming more aggressive around the current at the money zone. This makes 24,600 a crucial hurdle for Nifty. A sustained move above this level would be important to challenge the next resistance zone. On the downside, 24,500 is the immediate support zone. Below that, the broader demand floor is placed between 24,400 and 24,000 for this expiry series. So, for the coming sessions, 24,600 remains the key level to watch on the upside, while 24,500 and the 24,400 to 24,000 zone remain important supports. Now, let's look at participant-wise positioning. Retail traders remain strongly bullish, with a net position of around 3.15 million contracts, showing strong optimism. FIIs remain cautious and hedged, with short index futures but long stock futures, suggesting no outright bearish stance. DIIs hold the largest negative position of nearly 4 million contracts, mainly due to heavy short positions in stock futures, indicating portfolio hedging. Meanwhile, proprietary desks remain mildly bullish to neutral. Overall, the data shows strong retail optimism, cautious FII positioning, and heavy DII hedging, suggesting that while sentiment remains positive, institutional positioning calls for caution at high levels. This video is for educational purposes only and should not be considered investment or trading advice. Please do your own research or consult your financial advisor before making any investment decisions.